Okay, folks, welcome to this week's review from Magnetic Trading on the index market. So as usual, we are going to kick off the week going through how we fared on the markets last week with our own trading and also on the advisor program, which again, these are the trades that mirror our own trades that we are taking here at Magnetic Trading. We're also going to go over one of the most important reasons why traders can't get from retail performance up to professional performance with their own trading. So there's one vital thing that they're doing wrong, which is preventing them getting to that next level. So you definitely want to hear about that, and I'm going to teach you some tips on how to improve that part of your trading to get you to that next level. And we're also going to give you some weekly analysis on the FTSE. All right, let's kick off then. So last week we had a win on the FTSE expiry. That's the trade that I headed up to you last week. Told you it was going to be very high probability. Nice winning trade on that yesterday. We had one reduced loss on the FTSE, so that means that we had a trade in the week which we'd gone in officially, but it wasn't working quite right, so we reduced the risk. Remember, on trades where we see a little bit of risk coming into the environment, what we'll do is we will lower our risk profile, which means that when we do lose, we're losing small. And then, of course, unfortunately, the ASX expiry lost as well, which is another high probability trade, but it was just one of them. ASX actually this year hasn't been performing that great for us. ASX really, we probably trade about 5% of our own portfolio on that index market. It accounts for a very small portion of our trades. Mainly we're focusing on the DAX and the FTSE, which we're far more successful on, and of course the NASDAQ as well, which we have a few trades on. So ASX was a loss, and then actually all of our unofficial trades that we did in our live room last week were winners. So our unofficial trades, we recommend our clients go in just 0.5%, and they're trades which are still very good, but they don't quite make it to official status. So these are for really people that want to trade a little bit more actively on a smaller trading account, and this enables them to do that. So all of them won, which was nice, and we do them in the live trading room. So people log in to a live webinar session with us and we'll trade live with them. So the FTSE expiry trade, which we were talking about last week, actually has a 90% win rate now. So since June 2018, where we officially released this to our client database, this is running at a 90% win rate. So really, really high. And again, in trading, it's very hard to get to a level where you're up in that 90% winning rate. So we're pretty proud of that one. And really the trade looked like this. So 10 past 10 yesterday, we expected a large move for 5 minutes of action, either to the upside or the downside. It doesn't really matter which way the action is, but we are expecting that market to move on up or move on down, but then retrace back to the median point. So if we look on this chart, we'll see that the market opened at 10 past 10. We got the move up in those first 5 minutes, and we basically sold the FTSE on that move up, expecting the market to move all the way back down to 6030, which it did. So a nice textbook trade on the FTSE there. Now, moving on, the reason why a lot of traders fail or don't get to the next level of where they're making consistent money is because of stops. So we obviously have to have stops in trading. You cannot trade without stops, but you want to use a different type of stop to what a lot of people are using. The reason for that is that market makers. So market makers will often go for obvious stops in the market because the markets are there to maximize trade. They're there to facilitate trade and match up buyers and sellers. So when trade volume is pretty low, the market makers will often shift the market to an area where stops are clipped. So you don't want to be putting your stop in an area which is obvious, because then you're getting into the churning stage where you'll make a win, then you'll make a loss, then you'll make a win, then you make two losses or whatever. Maybe then you'll make a big loss. And you're really just churning your account. And I believe it's because of stops. People are using the wrong stops. They're putting them in obvious areas where the market makers see a big cluster of stops, and the market will come down, clip those stops, and then they'll get on with their move. So how can we get around this? Well, what you can do is you can add a nominal amount onto your stop level. So just say you wanted to put a stop at 6,000, for example, on the FTSE. It's a big round number, and that's where you feel that you should put the stop. It's a very obvious area. So what you could do is then just maybe have a nominal amount of 15 points, which you add on to your first obvious stop level that you think about in your mind. Because generally the stop level that you think about is also going to be the level that all the retail market are also thinking about. So do something with counter intuition. So put your stop somewhere where the herd are not putting their stops, and you're less likely to get clipped out of a trade. So that's one thing. Add a nominal amount onto your obvious stop level that you're thinking of. The other areas I'm going to look at on the charts now. So one is called acceptance. So let's now go over to the charts and have a look at what acceptance is. All right, guys, so this is a FTSE chart. And actually, let me just go over to a 5-minute chart. It's easier to use. So actually, with my reports this week, we've actually been looking at 6050 as a real key level in the market. So what we've been telling our clients all week is that above 6050, the market is bullish, but below 6050, the market is still bearish, and we're likely to see downside in the market. We'll look at my report actually in a second, and you'll see what I'm talking about. But you'll see all week we've seen this action. We've seen the market bobbing up to around 6050, and it's been rejecting. Now, the obvious level, if you were selling this market, say at 6030, if you read my report, would be to say, well, I'm going to put my stop at 6050 because Mark said that the price action below there is negative. So if it gets above 6050, then I should come out. So the retail market would either be putting their stop at 6050 or maybe a break above there. So if you'd done that, you would have actually got stopped out only to see the market move all the way back down lower in the day. So actually you were right with the analysis, but your stop placement has triggered you out of the market. So what you can do is you can use a method called acceptance. So what this is you wait for a 5-minute bar. Now this is for short-term trading. I'll talk about long-term trading in a minute, but for short-term trading, you can use a 5-minute chart. And what you do is you wait for a full 5-minute bar to close above the key level in question. And once you've seen that, it requires a 2-pip break beyond that level. So you'll see in this example that this bar here was not fully above 6050. The bottom of the wick was below 6050. This bar also isn't. This bar wasn't. This bar wasn't. This bar wasn't. This bar. So none of these bars actually completely closed above 6050 and then saw a 2-pip break. So actually, if you're using acceptance, you would have remained in this trade. And basically, you're wrong until you see that 5-minute bar close a fully form above 6050 and then a 2-pip break above that level. So that is acceptance, which you can use, and it's very, very effective. Now, if you were looking at a longer term trade, so We can use the daily chart for an example here. We actually have, again, on our reports, 6550 as a long-term level. Again, we'll look at the reports in a second that we issue out. But 6550 is real important, and you'll see actually that this level again was attacked. Let me just blow this up a little bit for you. This level was attacked. So each bar here represents a full day of action. We'll see that we didn't get a full bar close here. We didn't here. We didn't here. We didn't here. We actually got it. We got it here. So this is the first bar that actually completely closed above 65500. So what you do is you would basically get long on a break of this bar, and really the stop for this bar, you're wrong if you then see a subsequent full daily bar close below 6550. So it can be a method of telling you that the market is actually bullish. It's not just a false break. And also it can be a method for an effective stop loss. So this is for your long-term trading. And really, you know, we had a retest back at this level here, back on the 16th of April. It got down to 5529. So again, a false break below 5550, but we didn't get the full bar closing out. So you wouldn't have come out of the trade. And then of course it just kept on going up, and it's been above there ever since. So I'm actually long-term bullish unless I see a full daily bar close below 5550, and I'll keep buying sell-offs in the market on the FTSE really until the market tells me that I am wrong. So hopefully you found that useful. Actually, let's just have a look at our report so you can see what we're talking about. Okay, so I've actually just gone into my email for this, but this is the alert we issued on Friday. And you'll see that here again, reference to the 6050 level. So we have been looking to sell this market at 6050 with stops above there. And again, had you not really known about acceptance and been using real tight stops above 6050, you would have actually been clipped out of the price action. But those using acceptance, these are methods that we actually teach our pro traders and also advanced price action. They are still in these trades because they know how to positively use stops and not get clipped out by the market makers at these key levels. Again, these reports, they are our trade plans. We post them into the phone app every day so our clients can see what we're doing. But again, it really was all about 6050. And you'll also notice that long term, we're talking about this 5550 level. So again, above that really, we're still looking to position long term for investments on the FTSE 100. Okay guys, so hopefully you found that useful. Let's just go and have a look at the analysis for the week. Okay, so 6060 remains really important. 6050 to 6060 is still a key level for us. So whilst below there, we're actually going into next week bearish. So we'll be looking on the short-term charts for sell reasons. And again, unless we get 5-minute bar acceptance back above 6050-60, that sort of area in the market will remain bearish. But if I start seeing acceptance, and certainly if we get a daily bar closing above 6060, then we'll then be looking to get bullish on the short-term charts. On the long-term charts, we remain bullish anyway. Any big sell-offs I see going forward, I'll be looking to buy. And again, my stop loss is really a daily acceptance below 5550. We're going into the last quarter as well. That can be a bullish quarter, especially leading up into the end of the year, Christmas rally. So again, any big sell-offs that we get over the coming months, we'll be looking for longer term trades on the FTSE. Have a great week trading, guys, and we'll join you next week.